Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his Monday expert, Mr. Greg Dickerson. How you doing, sir?
Doing fantastic, Michael. How are you today?
I'm doing very well. So this is part two of a three-part series. Part one was, hey, there's a lot of major headwinds. What's going on with the world, the consumer, cost of capital, cost of money, all that stuff. Episode number two, what are the chances that we see a 20% drop in some assets in a relatively quick fashion? Say within a 30-day period, there will be some assets that are repriced and see a dramatic 20% drop. Do you see that as a possibility out there?
Yeah, I mean, anything's possible depending on events in the market. And, I'm looking right now, the last time we had a big drop like that was obviously the pandemic. And that was, that took place, that was 37% in the Dow, something like that over a month's time period. Yeah. So the last time we saw something like that was the pandemic. And then, there was a couple of corrections along the way that took place over a couple of months of about 10% here or there. So yeah, given the right circumstances and the wrong action by the Fed, you could see, you could see 20% come off the markets real quick. But generally, like I said, the worst ones we've seen generally take at least a month or so. It doesn't happen overnight. There was one right before the pandemic, back in that December, January timeframe. And it started October 18th when the Fed started talking about raising rates and bottomed out on December 18th or December 2018. So October to December. So that was the last time the markets dropped 20% before the pandemic, when the Fed came out and raised interest rates.
Yeah, and in the real estate market, prices didn't fall, at least nationally. But transactions certainly stopped. I remember that being quite vividly.
Yeah, and that was that was a 90-day period that it took all that to play out. But the biggest drop occurred in about 25 days.
Yeah. So the other thing I always talk about, because again, I experienced it up close and personal, was the dot-com crash. And a lot of people now who didn't experience think that the dot-com crash happened in a week or a month. They think it was sudden and like everything disappeared. In reality, the dot-com crash was a 4 or 5 year kind of bottoming out. Yes, some companies lost value faster than that, but peak to trough for the NASDAQ was a 5-year journey, death by 1,000 cuts. It was long and painful. And really what you had is, even back then, you had a lot of buy the dip fans, right? Buy the dip. And eventually people became the dip. And then people finally gave up, myself included, right? They started saying things like, I'm never going back in the market, things of that nature. What I think happened in the pandemic, right? March of 2020 is buy the dip got reinforced, right? We saw a 31 or 37% drop inside of 28 days. And then it came roaring back, the classic V-shaped recovery. I think what we're in for today is not a quick 20% drop in a day, but it's a negative slope probably for quarters. What do you think of that?
Yeah. Looking back at that 2001 NASDAQ event, that was basically 92 weeks is what that took. Is that right? Yeah, I'm on the weekly chart. I'm just looking at it right now while we're talking.
So about 2 years then. Yeah. Okay.
Yeah. 938 days. Yeah. So basically
3 years.
It's about 3 years from the peak to the bottom.
Okay. Yeah. That's what I remember. And it was, and reason that is a lot of people think the dot-com crash was sudden. If you were to ask most people today, how long was the dot-com crash? I would guess that most people think it's 6 months or less. And it just wasn't.
Yeah. The initial pop, so the market peaked on, March 20, in 2000, right around March 20th of 2000. And then it dropped basically from that point about 35% over the next couple of weeks. So there was a first initial big drop, and that's what a lot of people, the first month, a lot of people kind of remember that. And then it bounced around a little bit for a few weeks. Probably after that first initial drop, it was about 148 days that it bounced around again until it dropped and had another leg down. And that was a big sustained leg down there, kind of like what we're in now, just dropping, with bounces here and there. But that was over, a period of about, 217 days, then it bounced and it dropped again, then it bounced and dropped again. So yeah, it's not a straight line down. What's interesting is, and this is the thing to look at for everybody out there who's, diamond hands and buy the dip, and where I talk about buy the dip, become the dip. So if you're buying the dip all the way down and dollar cost averaging all the way down in that time period, it took you till January of 2016 to get back to where the NASDAQ was before it crashed.
Yeah. And I've tried to tell
How many
people,
years is that? That's 16 years.
Yeah, 16 years. Exactly. And there
16 years just to get back to where the market was, where the NASDAQ was before it dropped, in that time period.
Yeah. And there are these diamond hand cohorts just don't understand. Cisco Systems happens to be a stock that I was trading, and it is still not back to the peak. Its peak. It got within 10 or 12%, but it's still not back 22 years later.
Yeah.
Right? Like GameStop or AMC or any of these stocks that became meme stocks, there's a very good chance that you're 30 or 40 years before you get back to even, right? So people understand the opportunity cost or understand dead money.
Yeah. Yeah. And so everybody take, like Kathy Wood, long-term, I've got a 5-year outlook. Well, if her 5-year outlook was at the peak of the NASDAQ, she was done. And we very well could be done right now. We could have seen the peak in these markets for the next, 5, 10, 15 years. We don't know. Yeah. Without the Fed, injecting liquidity, and without QE, all you can do is go back and look at what happened any other time the market deflated, like it's having to do now. And how long did it take to recover? And every time, even in the real estate market, we talk about that a lot. The peak of the market was 04, 05. It bounced back up in 08, 09, tanked. It was 14 years, for values to come back in a lot of areas. So, these things can take, 10 to 15 years to recover. So you got to be real careful about where you enter, what your long-term plan is, and what you're going to do if the markets start to have an event like they are now. And that messaging of diamond hands, comes from Wall Street, where you get investment bankers and fund managers, talking their books and telling everybody to buy the dip, because that's how they make their money. So they have, they go on TV and do that, and then people get conditioned for it. And unfortunately, people are doing it now. They're buying the dip all the way down. And I'm not saying that's wrong. I don't know what the market's going to do. I don't know if it's going to, snap right back. And, it shouldn't. If the Fed's not there, it should deflate and reprice. And that's what, normally would happen. But, until the Fed gets out of the game, we don't know what's going to happen.
Yeah. I don't know if I've asked you this before, but where do you think the Fed has to get rates? Today, the overnight rate is basically 0. Do you think they've got to get it to at least 2% so they're back to kind of even and they have ammunition if another event happens? Or do you think they chicken out at 1%? Have you given that any thought, or you just don't think about that?
Well, they gave up at half a point last time. I think
that's true.
Yeah, quarter point or whatever it was, and Powell did an about face. But the last example we've seen was, prior to 2008 and 9, I think the rates, hit. I mean, we haven't gone beyond 2 in I don't know how long, recent history. It's been, last time I looked, I don't think we've gone above 2% in a long time for the Fed funds rate. Yeah, and anytime we get close to that, it's Armageddon, and they have to back up and drop it right back. And I think it was around 08, 09 when that happened, when, rates started ticking up around the 2.5. I think it got to 2.5%. Okay. And then, they had to backtrack. And, I'll look that up while we're chatting here, because that would be an interesting thing to look at.
Yeah, I think my opinion only, as I sit here right now, events could change, like we said in episode 1, but I think they've got to get the Fed's funds rate over 2%, not, somewhere between 2 and 2.5.
Yeah.
They just, and again, like we said earlier, they're in a bad spot. You either hurt the consumers or everybody, or you hurt the rich, or, by rich, I mean the owners of assets, right? If you own assets, inflation helps you. And,
okay. So here's what I'm talking about. So 2000 rates were at 5.4%, and then it dropped in 2001 down to 1.5. They had to respond to that crisis, right? So, they dropped rates, down to 1, and it stayed under 2% until 04, 05. And this is what happened. And I was preaching it back then, that it was, that the market values were all about interest rates. And people, just like I hear now, said, oh no,
You don't know what
that's
you're
not going
talking
to affect, right. That's not going to affect values. I said, you watch, we get over 5%, lights out. So 04, 05, 06, that was the peak of the market originally. Rates got up to 5%. That was it. Lights out in the real estate market. And then the reaction to that was drop back to zero. And we've been on zero ever since 2008. It went from 5% in 2006 to 3% in 2007 to 0.14 in 2008. And then it stayed under that. The last time it got over 2%, 2018.
Wow. I can't believe the Fed funds rates was 5% during my lifetime. That's crazy.
Yeah, I remember that,
Wow.
and I told everybody back then, because what drove the market in 2000, prior to 2004 and 5, which was the peak, 08, 09 was the bubble,
Right.
But the values really peaked and the market started changing 04, 05. It was all interest rates, because interest rates were dropping leading into that. And, then we started getting all these, exotic, loan options and and all that. And, the things that we've talked about before, all these exotic loans and stuff, pay option arms and, no doc loans and all that kind of stuff. And, that's what really drove the crash in 2008, 9 was the subprime mortgage crisis. It was mortgages that were being given to unqualified borrowers on interest only loans that, once the rates went up, tanked it. And that's what happened. And I was watching it as it was going along. And I was writing articles for newspapers back then and being interviewed on Fox News about it. We were talking about it. And, and I'm just like, look, 5% is the number. You get over 5%, we're done. And sure enough, that's what happened. And it triggered that domino effect, because all of the interest only loans that were, given to borrowers that couldn't afford the payments. And, our environment's a little different now, because people have to qualify for loans. They have to put money down. And they're getting more long-term fixed debt for residential, for owner-occupant residential loans. So the market's very different there. The danger is in commercial. And we talked about that last time.
I've been screaming that. I'm seeing still IO one. I can't.
Yeah. So a lot of these big commercial deals, multifamily, commercial, retail, you name it, the only way these deals are working is short-term interest-only loans. And, like Grant Cardone, all of his loans are short-term, 3-year, 5-year, maybe 10-year interest only. So as these rates go up, his properties, they're underwater, and it takes a very little move in interest rates to affect a property like that. 30, 50, $100 million property. If your interest rate goes up a half a point, man, your cash flow is gone. You're negative all of a sudden.
Yeah. I mean, I'm seeing, because again, right, we're both accredited investors and I get a lot of deals sent my way. I've seen so many deals recently with 1-year bridge debt, 1-year IO bridge debt. That stuff. I mean, I couldn't imagine signing that paperwork today.
Yeah, 1 year, 3 year, 5 year. Well, the thinking is they're just going to raise rates.
Well, of course, that's the thinking.
Yeah.
Well, the real thinking is they don't have any money in the game. They're going to get paid to manage the deal. They're going to make their money as an operator, and they're going to leave the investors with the bag. That's what I think is going to happen. But man,
some of them, and that happens. Some of them work that way. Other ones are more sophisticated and professional, and they understand how to assess the risk, manage it, and they are in a position to be able to raise rents on some of these properties, but there are others out there that, they just don't care. They're just trying to get these acquisition fees and do as many deals as they can.
Yeah. I mean, there's a lot of folks that they've built up so much overhead, right? Employees, office buildings, all of these things, that they have to do deals to fund overhead. And unfortunately, I think that's going to end pretty badly. I guess the thing to kind of round out episode 2 here is, at least what I think we're both saying, is the chance of an immediate or drop of 20% in a very defined window is unlikely, unless an external event. But what is very likely is we're going to be in for, dozens, if not 100 weeks of pain, right? That kind of, I forget, it was 100 weeks or something you said earlier about the NASDAQ. I think that's the environment we're in. It's going to be a slog for a year.
It was a long time. And, for everybody listening, the interesting thing about 2000, 2001, there was 2 groups of people. One were a lot of people that I was doing deals for, working for, and building houses for. They were cashing out at the peak and coming and buying real estate. And so that was very interesting to me. And a lot of them knew it. They're like, this bubble's getting ready to blow. We're taking our money out and we're going to put it into hard assets. And, I'm working with a lot of people doing that now.
Yep.
So, that's one thing. to keep an eye on. The other one was the group that was like, it's just going to keep going. It's never going to end. And, 5 years from now, it'll be worth twice as much. 10 years from now, I saw it both in real estate and in the dot-com bubble. At the peak of the real estate market, people were telling me, it's going to be worth twice as much in 10 years. And it took about 10, 15 years to get back. And it still hasn't doubled, from where it was, but it has appreciated just because of what the Fed's done, buying mortgage-backed securities, keeping rates artificially low. And then, of course, the pandemic created such a huge demand in properties, but all that's going to flip and change. More inventory will come on the markets. Things will change once we're out through the pandemic. That demand cycle will shift. So, it's going to be interesting to see how the market reacts, the housing market, to rising interest rates and how quickly.
Yeah, I think that's very interesting. We're probably going to talk about that in episode 3, but I want to highlight that one more time. A lot of what I saw, and again, I was part of that cohort. We got burned in the stock market. We thought that was our key to wealth. And we came out of that. And again, a lot of us, myself included, we went to zero in the stock market, and we moved our whatever we had left into hard assets with fixed rate debt. And I think that could very easily happen again, right? It's a casino. The rules aren't fair. They take out the little guy, and you just move your assets into rental properties because, again, rents are up, fixed rate debt. It's far easier to understand. Do you think that might happen again?
Yeah, you're already starting to see it. I know a number of people that are exiting with profits from stocks and crypto and putting it in real estate so they can get cash flow, and they've got income in case the markets tank and things like that. So, people have different philosophies about it, and, everybody has to make their own decisions, whether you take all your chips off the table and reinvest, or if you take profits out and leave your base, whatever you want to do. Markets ebb and flow. They come in, they peaks and valleys. The thing that you really have to watch is when you get into a recessionary environment and a downtrend in the markets, they can be sustained without Fed involvement. And we have not seen that since, before 2008 and 9. We've been in an artificially inflated environment at all assets since 2008 and 9. And until we no longer have that, we're not going to know what the results are and how long it's going to take.
Yeah, I couldn't agree more. Well, Greg, how can people find you?
Yeah, gregdickerson.com. All my info's there. YouTube channel, social media links. Go check it out.
Thanks, buddy. Appreciate it.